Good morning.
How you doing?
Good morning. Good morning.
We're good. So I'm a small builder, small being custom homes and remodeling. I'm nearing retirement, my wife and I. We're in our late 60s. Although I'm physically fit, I intend to keep this going because it's more of a management situation than physical work. And we just went into a subchapter S corporation rather than a C corp, which I had been for years. And I'm looking for alternates to take money out of the business for us, short of a 401k or something that has a big management expense, annual management expense. I've been told that a simple IRA is a way to take some additional funds out besides just the 6,500 IRA withdrawal.
Well, you could do a SEP IRA.
Yeah. So, Rick, great question. You got some moving pieces there. So let's just clarify. So when you say take money out of the business, you're looking to basically contribute to something where you would get a tax deduction, and that would reduce the earnings, so you're not paying tax on those earnings right now. And
correct.
And so, I think that are the people who work for you all employees, or are they independent contractors, or how does that work?
So we're a mom and pop organization. We subcontract everything to employees, my wife and I.
Okay. So who are the employees in the business? Just you and your wife?
Correct.
Okay. Well, look, Rick,
simple one-man 401k.
A solo 401k could be a great solution. It has very attractive contribution limits that are about twice, well, really probably 4 times when you add the profit sharing component in. So that's something that you and your wife could contribute a lot of money between salary deferrals and profit sharing. I mean, you could get probably up to $50,000 plus a year a piece,
right?
And be able to deduct that. Which the simple IRA, the limits on the simple are about 16.5 for folks in your age group. So you could do a lot more, and there's really no administration until the balance of that account grows beyond $250,000, and then the administration is not onerous. So I don't know who you're talking to about high expenses and that sort of thing. I think it just depends on if you're going into some kind of group annuity product or something like that, it might be more expensive, but otherwise. I certainly wouldn't let that be a reason to deter me. Joe, what do you think?
No, I agree with you 100%. As Chris said, between you and your wife, you could put in over $100,000 on a pre-tax basis. If it's combined with the profit sharing, and the profit sharing, once again, is you determine that every year whether or not you have profits, and you can set up a one-man, in this case, a one-man and spouse, simple, we call it a uni-K, for very, very modest costs. And then when you get over 250 in terms of account size, then you'd have to have a little bit of administrative work to be done for you to file what's called a 5500 form. But the tax savings alone will more than offset the modest cost that you'd have in that. So